While everyone is hyper-focused on tech and AI stocks, here comes in SCHD to reach all-time highs. You'll see it here on this chart. It's a 5-year chart. It just went over the $82 per share mark to reach its all-time highs. So yes, over the past 5 years, it's averaged about a little over 10% per year annualized returns. You'll see over the past 5 years, it's up 53.15%. So sure, for a few years, it did underperform. Believe me, I heard every trash talking investor on different platforms bash this fund. But if you kept in mind that the high interest rate environment the Fed has been keeping is a direct competitor to high yielding stocks and funds, then your common sense would have looked into the future and would have known that once rates get cut, or at least the prospect of it gets more and more probable, a high yielding fund such as SCHD would have its competition reduced and become more and more attractive as an investment. The same goes for REITs. Over the past 2 years, actually, I've been really pounding the table at buying REITs, that's saying they're undervalued right now with the rate environment, as well as SCHD, the fund. And I really pumped up my investments in these areas, and I will show you my portfolio at the end so you can see just how much they make up of my portfolio. So now, before you say that my stock X and my stock Y grew faster than SCHD, so what are you happy about? Well, you're probably someone that is comparing oranges to apples. Many investors compare growth stocks to SCHD. I see it happen all the time. They're saying, why isn't SCHD growing as fast as Apple? I mean, one's an orange, one's literally an apple. So many investors do compare growth stocks to SCHD. SCHD is not a growth stock. It's a tool used for passive income. SCHD is there to provide stable, growing, passive income. That's a totally different investing style than that of a growth-focused fund or stock. So make sure you're not making unfair comparisons here. SCHD is there to be dependable, pay a growing dividend, and do so while your fund appreciates in value, like hitting all-time highs regularly, like any good investment should be doing. The economic environment affected this stock recently, not the strategy itself. You got to keep that in mind. So we'll see here a summary of this fund. What I really like, it's got a low expense ratio because those expense ratios can cut into your profits long term if they're high. This is very minimal, one of the lowest out there at 0.06%. The objective is the fund's goal is to track as closely as possible before fees and expenses the total return of the Dow Jones US Dividend 100 Index. Now, some highlights is that this is a straightforward, low-cost fund offering potential tax efficiency. The fund can serve as part of the core or complement in a diversified portfolio, though I think you're diverse enough with an ETF, but you probably want to place a few individual stocks and maybe 1 or 2 other ETFs as well. And then it tracks an index focused on the quality and sustainability of dividends. That's, again, this is not a growth stock. It's really about stability. It's about that passive income. And then it invests in stocks selected for fundamental strength relative to their peers based on financial ratios. So of course this fund is passively managed. It has these calculations in the background to look at these investments, look at the financial ratios, and make sure they fit the goals of this fund, and it brings them in. That's one thing I like about ETFs is it takes out the bad performers. You know, they do a rebalance every so often, and it puts in the good performers. It might adjust allocations a little bit. It does all that for you. You do not have to worry about that, and that is excellent. It's guaranteeing that it's choosing the best of the best, and that's what I like about SCHD. Now, the yield currently is about a 3.63%. So yes, it's not as attractive as a lot of bonds right now, or maybe even high yielding savings accounts, but this will get more and more attractive as time goes on and rates get cut. Plus, remember, this yield grows where we're looking at cuts to interest rates and to those high yield savings accounts and those bonds. Eventually those will get less and less attractive, and this will get more and more attractive. And if you bought into this fund a long time ago, your yield on cost is probably a lot higher than the current yield of 3.63%. So keep that in mind. Also, if we look at the annualized returns, we'll see here since inception, you got returns on average annually of 12.84%. That is excellent, especially when you also add in the dividend, the yield. And then on a 10-year annualized return, you're getting about an average of 10.84. 5-year got a little better at 11.79. Now, the low point is the 3-year mark, but that is a special case because we had an economic environment where they had to hold rates high to help prevent us from spiraling out of control. So this is a rare event and probably won't happen again for a long time, but look at the 1 year is already bouncing back and it's 11.17 annualized return. So yes, this is great to see. Keep this in mind. Don't be in that 3-year mindset. Be on the long-term, wide view mindset, knowing that long-term, this fund has generated between 10 to 12% of annualized returns for investors. Now, its top 10 holdings are great companies: Home Depot, United Parcel Service, BlackRock, Texas Instrument. We have AbbVie, we have Chevron, Coca-Cola. I mean, we have great investments. And you'll see here their weighting, it's pretty even amongst all their holdings. And that's what I like. Yes, some other funds that don't do that even weighting is more beneficial in ways, but I think when it comes to a fund like this with the passive income in mind, you want something stable, you want something safe, and this is a good way to do it. Now, sector-wise, they're heavy in the financials and healthcare sector. Now, I've been reading a lot lately that these two sectors are poised to outperform over the next couple years, so I really like that they're focusing on it. And of course, on the low end, they have utilities and materials and communication services in the bottom there, which is great because those are very slow growing sectors of the market usually, especially with investment. So I like the weighting here. Also, as far as the market cap that they invest in, their companies are mostly large cap stocks. Those are the more dependable, strong and sturdy, proven businesses. Again, another positive sign. Now, if we look at my portfolio, we're going to dive right into this. I have been doing pretty well. I was around 20% for a while. Now I'm at 25% in the green, and I can attribute that to my investing strategy. I am focusing more heavily on growth, but I do have some stocks and funds in here that focus on that yield, creating that passive income. So you'll see at the bottom left, there's SCHD. It makes up, in purple there, 13% of my portfolio, and it's in the green for me, almost 20%. I will keep this with an allocation between 10 and probably 20% over the lifetime of my portfolio, because I also have real estate. This is another one I was pounding the table on, saying these are a buy for the last 2 years, and now look at them. They're in the green. They're starting to rev up, and Vici and O both make up about 22% of my portfolio. It's a very big holding. Vici, of course, is a big one, but they're both now in the green, 5%, where they were in the red about 5% for quite a while. So yes, I could go in here like some other investors and say, well, Microsoft's in the green 86% and SCHD is in the green 20%. What's going on? What the heck? Again, that's unrealistic. You can't compare a growth stock to a passive income fund. It's just not how it works. So what I'm building is a portfolio that is focusing more heavily on growth because I am young. I'm relatively young still, but I'm also starting to build on the back end these passive income, high yielding stocks and ETFs, because eventually I will transform from more of a growth to more of a passive income portfolio once I get, older and closer to retirement. So those who were patient, it does pay off. Many sold out at the lows, a very common phenomenon with investors that are impulsive and not patient and have fear of FOMO. They sell out at the lows and buy at the highs. I see it happen all the time. It's just a tale as old as time. But let's not do that. It's easy to get emotional, but those that stick to their strategy, avoid the noise, and continue to learn and invest in a responsible, proven way will be the ones that make the profits and have those 1 million plus portfolios. So it makes sense why this fund is reaching all-time highs. It's a simple equation. As the prospect of rate cuts becomes more probable, this fund's becoming more attractive, more competitive. So SCHD is still an excellent high-yielding fund that still provides an average of that 10 to 12% annualized returns on top of the growing dividend. So you get two pretty good sides of this fund that create some pretty good returns for your portfolio and passive income. And if your goal is to create another source of income where your money works for you instead of you working for your money, SCHD is an excellent choice because when it comes to income, we want stability, not volatility. So let me know if you're an SCHD hater or lover and how much it makes up of your portfolio if you do hold it. And if you know of any other good high yielding funds you'd like to share, please do. That's all for today. We'll see you soon on Mark Arnold's Finance. Have a good one.